Welcome to another deep dive. Today, we're taking a closer look at a company really in the midst of a fascinating shift. Piramal Enterprises Ltd, PEL. You know, the diversified NBFC.
That's right.
We've got the key documents here, the press release, investor deck, the full earnings call transcript, everything you need.
Yeah, the whole stack.
Our goal, as always, is to give you that essential insight into where PEL stands after Q1 FY26. So you don't have to wade through all the raw data yourself.
Exactly. Mission today is cut through those numbers, pull out the really important stuff, those aha moments that show you the strategy, the operations, and what it all points towards. The big picture. Q1 FY26 highlights and strategic momentum.
Okay, let's jump straight in. Q1 FY26 headlines. What immediately jumped out at me from the press release was that profit after tax number. Impressive, right? 52% year-on-year growth.
Yeah, hitting INR 276 crore. That's strong.
And the total assets under management, AUM, also solid growth. 22% UI takes them to INR 85,756 crore.
Right. And don't forget the net interest margin, the NIM. That improved too by 10 basis points just quarter on quarter, now at 5.9%.
So decent top-line numbers there.
They really are. But, the why behind these numbers is where it gets really interesting. It's all tied to that big strategic shift PL has been driving.
Ah, the growth versus legacy mix.
Exactly. Think about this. That growth to legacy AUM mix is now 93.07. 93% growth assets.
Wow, compared to just a few years ago. What was it, FY22?
Yeah, FY22, it was basically flipped, 34.66. So 34% growth, 66% legacy. It shows they've really managed that transition, shedding or running down those older, maybe more challenging assets.
And the new growth business, PBT, profit before tax.
INR 295 crore. And that's pretty much driving the entire consolidated PBT of INR 301 crore now. The drag from the legacy stuff. Almost gone.
So like Chairman Ajay Piramal said, starting the year on a strong note.
With profitable growth and disciplined execution. Yeah, sums it up nicely.
Now, part of enabling that shift has to be structure, right? And there's that big merger on the horizon. Piramal Enterprises merging with Piramal Finance Limited, PFL.
Correct.
What's the latest on timing, and what does it really mean practically?
Well, Q1 FY26 is probably the last quarter we see them report separately like this. The merger is expected by September 2025.
Okay, so very soon.
Yeah. And the main point is simplification. Get all the lending businesses under one roof under PFL. It also has a capital implication.
Right, the capital adequacy.
Yeah, it stood at 19.3% this quarter. But the merger itself is actually expected to reverse about 245 basis points of the reduction they saw end of last year. So it effectively boosts their capital buffer.
That's significant.
It is. And on top of that, they're sitting on quite a bit of liquidity. INR 9,070 crore in cash and liquid investments. That's around 9% of total assets. Gives them a lot of flexibility.
A good cushion to have. 2, diving deeper, retail lending, the growth engine. Okay, let's really dig into the core now. Retail lending, this is clearly the main engine driving things. Retail AUM grew, 37% year on year to INR 69,005 crore. Now making up, you said, 80% of the total AUM.
80%. It's huge.
So how are they managing that kind of growth? Especially when you hear the overall market for others might be like sub 10%. What's the secret sauce here?
Yeah, good question. I think it boils down to maybe 3 key things based on what they've said. First, segment clarity.
Okay.
They're really focused on these middle-tier product markets, places maybe underserved by the big banks.
Yeah.
And that targeted approach lets them kind of buck the market trends.
Finding demand where others aren't looking as hard.
Precisely. Second, it's the multi-product strategy. They're not just doing housing or just LAP. It's housing, LAP, used cars, small business loans, digital loans,
Yeah.
that whole mix. And diversified NBFCs like this, they often grow faster than the single product players.
Makes sense. Diversification helps.
And third, it's this high-tech plus high-touch approach. They've invested a lot in their branch network, 517 branches now.
Wow, that's a big footprint.
It is. 428 cities, 26 states.
Mm-hmm.
But it's not just physical branches. They're heavily layering on technology, AI, machine learning. That's what lets them scale that high-touch model efficiently.
Okay, so focus, diversification, and tech-enabled reach. Sounds effective, but with that kind of growth, especially into maybe newer markets for them, you always have to ask about asset quality.
Always.
The headline number, 90-plus days past due, or DPD, looks great. Stable at 0.8% for overall retail AUM.
Yeah, it does look good overall.
So are there any nuances under the surface? Any specific areas where maybe things aren't quite as rosy?
You're right to ask. The overall 0.8% is impressive, no doubt. And for their secured stuff mortgages, LAP, used cars, the same quality is very stable. Unsecured lending overall also saw some improvement, especially in salaried loans where disbursements were way up, 57% YoY.
Okay.
However, they were quite transparent on the call about a couple of, let's call them pockets of deterioration.
Okay.
First is in MSME unsecured loans. That's about 6% of their total AUM. And specifically, it's the loans sourced on the open market, not cross-sold to existing customers. They track like 30 industry sectors for MSME risk.
Right.
And in Q1, the credit risk for new loans actually got worse in 23 out of those 30 sectors. So they reacted quickly, pulled back disbursements in that segment by 30% quarter on quarter.
Wow. Okay. Proactive move.
Yeah. The second area was what they called an unseasonal uptick in risk for used car finance, which is 5% of total AUM, specifically in the refinance part of that book, and mainly with self-employed customers.
Interesting details. Shows you're watching closely.
Exactly. And one more thing on credit costs, they actually benefited from an ECL rebalancing this quarter, expected credit loss provisions.
Right. Setting money aside for potential losses.
Yeah, they do it annually in Q1. And because their internal data is showing better performance than maybe external models suggested, they could actually reduce provisions by about INR 105 crore. That helped bring their overall growth business credit costs down to 1.4% from 1.8% last quarter.
So better internal performance driving lower provisions.
Got it. A nuanced picture on risk, but sounds like they're managing it actively.
Seems so.
Now, let's switch to efficiency. That OPEX to AUM ratio, operating costs relative to assets, that's come down quite a bit, right? 230 basis points over, what, 9 quarters?
Yeah, down to 4.2% now. It's a really significant improvement.
How'd they pull that off? Especially while growing so fast.
Technology, AI, even Gen AI. That's the clear message. And they gave some pretty concrete examples, not just buzzwords.
Like what?
Well, there's Aria, this general AI assistant for their frontline staff. Imagine onboarding new people faster, giving them instant access to info.
Yeah, that makes sense.
They also mentioned AI generating credit memos, an AI tool to analyze bank statements faster, AI for fraud control, even AI handling customer emails end to end. These things directly boost productivity, cut down manual work.
So real, tangible efficiency gains from tech investment.
That's the story, yeah. Okay, looking ahead slightly. There are those new RBI rules coming, Jan 2026, about prepayment charges on floating rate loans for individuals and MSMEs.
Right.
How does that impact PEL? They must have some income from those fees, especially in LAP and MSME.
They definitely do. And those rules will impact that fee income stream. But the key thing is they have time until Jan 2026 to plan and adjust.
And they seem confident?
Yeah, they explicitly said they're not changing their overall guidance for the year because of this. Suggests they feel they can manage the impact, find offsets elsewhere, maybe adjust pricing strategies over time. 3, wholesale 2.0 and liability management.
Okay, let's pivot to the other side of the book, wholesale 2.0. That AUM grew strongly too, 47% YoY to about INR 10,425 crore. Disbursements up 46%.
Yeah, good growth there too.
And the really striking thing, zero delinquencies. I mean, zero.
In wholesale lending,
It is remarkable, isn't it? Especially in the current environment. Their explanation revolves around building a highly diversified and granular book.
Meaning smaller average loans? Exactly. The average ticket size is INR 74 crore, so they're spreading the risk. Not huge bets on single projects. Plus, they highlighted strong repayments, 43% of disbursements coming back as repayments in the quarter. That points to really rigorous underwriting and careful selection of partners and assets.
So discipline and diversification.
And they mentioned seeing strong tailwinds in specific types of real estate and also in corporate mid-market lending, CMML, finding good quality borrowers there.
Makes sense. And with all this growth, retail and wholesale, how are they managing the funding side? The liabilities, cost of funds coming down?
They're definitely focused on diversifying how they borrow, using more securitization, tapping international markets, trying to lower that cost. And the average borrowing cost has started to ease a little, marginally down to 9.12%.
Okay, slight improvement.
Yeah. They've also improved the fixed versus floating rate debt mix, now 54% fixed, 46% floating, gives a bit more stability. And crucially, their asset liability management, the ALM, looks well matched. Positive gaps across all time buckets.
So no major mismatch worries?
Seems not. And they also just got board approval to raise up to INR 1,000 crore via NCDs, non-convertible debentures, on private placement. Just gives them another funding lever. 5E. Outlook and key takeaways.
So bringing it all together, looking ahead, they've laid out this strategic path, shown strong Q1 numbers. How confident do they sound about hitting those FY26 targets they've set.
Very confident. They reiterated pretty clearly, on track to meet all these targets. That includes the overall AUM growth, hitting their target retail share, getting legacy AUM down further, and that consolidated PAPI goal of INR 1,300-1,500 crore for the full year.
In longer term, what's the ambition for profitability?
For the growth business specifically, they're aiming for a return on assets, ROA, of around 3% in the medium term, which is a decent step up from the current 1.4–1.5% range.
Right. And any need to raise equity capital this year?
They said no equity raise expected this financial year. They feel capital adequacy is comfortable. And interestingly, they pointed out that as they exit some remaining legacy investments, like the Shriram stake, some AIF recoveries, those have high-risk weights. So exiting them actually frees up capital quite efficiently.
Ah, okay. So capital release from exits helps avoid dilution.
That seems to be the thinking.
What about operational stuff? Like, are they still rapidly opening branches or exploring new product lines?
They mentioned a temporary pause on opening new branches.
Oh, okay. Why?
The focus now is on sweating the existing assets, getting more productivity, more products sold through the 517 branches they already have, make the current network work harder, basically.
Makes sense. Consolidate the gains.
But they are definitely looking at new things. They said they've started working on gold loans, testing different models, dedicated branches versus putting them inside existing branches. But they stressed it's a long-term play, like a 5–6 year strategy, not just jumping on a bandwagon.
Patient approach. What about digital lending? Any shifts there?
They seem comfortable, particularly as the market moves more towards first loss guarantee, or FLG models.
Where a partner takes the first hit on bad loans.
Exactly. De-risks it for PEL. They see this and a general shakeout of weaker players as positive. But they're avoiding the really small ticket, short-term, buy now, pay later stuff, sticking to more sustainable credit quality.
And loan against mutual funds, LAMF.
Yeah, they mentioned that too. See it as a big long-term opportunity. Maybe more attractive than loans against shares because the market's less penetrated and banks have regulatory limits there.
You know, this deep dive, it really paints a picture of a company, Piramal Enterprises, that's not just reacting, but really strategically using tech, using focus to build something quite specific. What does this maybe tell us about financial services and those Bharat markets going forward?
It's a great point. I think what stands out is that reliance on their own data for risk decisions, not just external models, that very careful, almost surgical approach to growing in segments that could be tricky. And the patience, right? Building out things like gold loans slowly, deliberately for the long haul. It suggests a model where continuous learning, adapting, combining that tech with the human touch. Maybe that's what resilience and profitability really look like in India's diverse financial landscape going forward. It really makes you think how that blend might reshape the whole sector.
Absolutely. Well, thank you for joining us on another deep dive. We really hope breaking down PEL's quarter like this gives you that valuable shortcut to understanding what's going on.
Yeah, I hope it was useful.
We'd love to hear your takeaways, your aha moments too. Feel free to reach out and look out for our next deep dive soon.
Definitely. And always remember, look beyond just the headline numbers. Ask why. That's where the real insights are. Keep learning.